What is the base currency in Forex trading? The Forex market is very active, with trillions traded every day. It's key to know about the base currency in trading. For example, USD stands for the US dollar. The base currency is the first one in a pair, like EUR in EUR USD. It tells us how much of the second currency is needed to buy 1 unit of the first. Traders buy and sell currencies at the same time in pairs. For major pairs like EUR USD or GBP USD, the US dollar is the base. They show the cost in the quote currency to buy the base, such as how many euros you need to buy 1 US dollar. Since the Forex market is always open, with traders looking at the value of the US dollar to guide their choices. The Forex market trades trillions daily, making it highly liquid. The base currency is the first currency listed in a currency pair. Commonly used codes include USD, EUR, JPY, GBP, AUD, CAD, and CHF. Forex quotations are given in pairs, indicating the buy-sell relationship. The most traded base currency globally is the US dollar. The base currency is a key concept in Forex trading. It's the first currency in a pair. This currency's value decides how much of the other currency you can buy. The base currency is the first one in a pair's name. In the market, it shows how much of the second currency you can buy with 1 unit of the base. For the GBP-USD pair, GBP is the base currency. Profits or losses in a trade are measured in this base currency. Common base currencies are USD, EUR, and GBP. They're identified with ISO 4217 codes. Big pairs usually include USD with EUR, GBP, JPY, CHF, CAD, or AUD. Exotic pairs, like USD-TRY, come from smaller or emerging economies. They often have less trade volume and wider spread. Here is a table with some common currency pairs and their base currencies. Currency pair. Base currency. ISO 4217 code. EUR USD. Euro. EUR. GBP USD. British pound. GBP. USD JPY. US dollar. USD. AUD USD. Australian dollar. AUD. USD CHF. US dollar. USD. It's vital to understand the base currency for good trading. You should pick a base currency based on the market's liquidity and economic strength. Knowing about base currencies helps traders in the Forex market. In the world of Forex trading, understanding the quote currency is key. The quote currency is the second currency in a pair. It shows how much of the quote currency you need to buy 1 unit of the base currency. For example, in EUR USD, the US dollar serves as the quote currency. The relationship between the base and quote currencies is vital. The exchange rate tells the ratio between them. This helps traders guess if the base currency will do better or worse than the quote currency. Wondering how currency exchange works? Here's a big part of it. Things like GDP and job data can change the value of currencies. These changes affect trading. But it's not just the numbers. Feelings about the market also matter. They help traders know if it's a good time to buy and sell currency. Traders look at different types of currency pairs. Majors, minors, and exotics are the main groups. Majors have currencies like USD, EUR, and GBP, where the quote currency really impacts trades. Minors and exotics, though, can be more unpredictable. This makes trade choices harder but possibly more rewarding. Currency pair type. Example, pairs. Major pairs. EUR USD, USD JPY, GBP USD. Minor pairs. EUR GBP, GBP IUD. Exotic pairs. USD SGD, GBP ZAR. Exchange rates are key in foreign currency trading. They show the value of one currency compared to another. These rates can change freely or stay fixed. Knowing about exchange rates is important in currency trading and when reading Forex exchange rates. When you read Forex exchange rates, you check the rate between two currencies. This tells you how much of the quote currency you need to buy 1 unit of the base currency. For example, an EUR/USD rate of 1.55 means 1 euro is worth 1.55 US dollars. This info is crucial in foreign currency trading. It helps traders decide when to buy or sell based on currency trends. Exchange rates greatly influence trading in the vast Forex market. Here, about $6.6 trillion of transactions happen daily. Traders watch economic news and central banks. They predict the effects of these and other events on exchange rates. For example, if they think the euro will do well against the US dollar, they might buy EUR/USD. If they expect the euro to drop, they may sell the pair. Knowing how exchange rates work is crucial. It helps traders make wise choices in their foreign currency trading. Several currencies are always used as base currencies in Forex. This is because they come from strong economies that are stable. For example, the US dollar, USD, the euro, EUR, and the British pound, GBP, are often chosen. Also, the Japanese yen, JPY, the Australian dollar, AUD, the Canadian dollar, CAD, and the Swiss franc, CHF, are here. These are known as major currencies in Forex. They are traded a lot because they are very liquid. This means they are bought and sold often. The US dollar is extremely important in the Forex market. The strength of the US economy backs it up. Plus, it's used in many international transactions and finance. The euro and British pound are next. This is because the European Union and the United Kingdom have a lot of financial power. The Japanese yen is important too. Japan has a big economy and the yen is often used in special kinds of trades. These trades take advantage of Japan's low interest rates. The Australian and Canadian dollars are also strong in Forex trading. Their steady economies and role in global trade make them valuable. The Swiss franc is known for being very stable. Switzerland's financial sector adds to its strength. These 7 major currencies make up 75% of all Forex trades. They offer more stable trading and lower costs, which can mean better profits. These 7 major Forex pairs are very popular worldwide. They offer a lot of trading opportunities and are key to the dynamic Forex market. Pip value is very important in Forex trading. It helps traders better handle their profits and losses. RPIPS is the smallest price change in Forex, showing the value's change. It stands for 1/100th of a percent, 1/100th x 0.01. For most currency pairs, like USD, EUR, and GBP, it's 4 decimal places, making 1 pip 0.0001. But for yen pairs, it's only 2 decimal places, so a pip here is 0.01. The pip value changes based on the currency pair, the exchange rate, and how big the trade is. For example, in the EUR/USD pair, a pip is valued at $1 for a 10,000 euro trade. Knowing how to calculate pip value is key for understanding possible profits and losses. Pips track currency changes in Forex. Brokers sometimes use pips beyond the standard 4 decimal places. These extra digits are called pipettes and offer more precise readings. A pipette is 1/10th of a pip for most pairs and 1/100th for JPY pairs. This tool helps traders fine-tune their strategies and improve their trading results. Understanding pip values and their calculation is instrumental for risk management and strategizing in Forex trading. Currency pair. Pip value. Decimal places. EUR/USD 0.0001. 4. USD/JPY 0.01. 2. Using a pip value calculator can make the process of calculating pip value much easier. For traders, such tools are critical. They help in understanding and using pip values better. This, in turn, helps in managing risks and improving trading strategies in Forex. Learning about leveraging and margin is key for anyone in the Forex market. This global market, with over $5 trillion trading daily, uses these tools a lot. They help traders make the most of their trading chances. Leverage in Forex lets traders work with more money than they deposit. This can range from 50, 1 to 200, 1 based on the broker's rules. This means even a small deposit can control a big position. Leverage in Forex is much higher than in stocks or futures, offering more trading power. But it's vital to know that leveraging has risks. It can boost profits, but it can also increase losses. This is why good financial risk management is a must. If a trade is losing too much, a margin call might force the trader to close it. Margin is the money needed to open and keep a leveraged trade. It changes with the base currency's value against the US dollar. Brokers might change the margin needed based on the trade's size or how volatile the currency pair is. For smaller trades, you might need less margin. But if you're trading in volatile pairs, you might need more. For example, trading the British pound against the Japanese yen could require a 5% margin. This is how margin and leverage work together. Charles Schwab Futures and Forex Division sets out specific rules about margin. They offer leverage up to 100, 1 which lets traders control more with less. Such strategies are a big part of smart risk management. For traders, finding the right mix of leverage and margin is vital. Using leverage well helps reduce risk. Less risky traders choose lower leverage, while those more skilled and tolerant of risk choose higher leverage. It's all about knowing your risk and skill level. To sum up, leveraging and margin in Forex can bring great opportunities, but understanding them is critical for managing risk. Trading in Forex can bring big wins, but it's important to be careful and have a good plan. In Forex trading, choosing the right lot size is key. It decides how much of the base currency you deal with. This choice affects both potential profits and risks in each trade. A standard Forex lot is 100,000 units of the base currency. It's big and favoured by pros for its high returns. But trading with such large lots means risking big too. Even small market changes can lead to significant profit or loss. Each pip in a standard lot is worth about $10. This big size isn't for everyone, especially for those trying to avoid big risks. Mini lots are 10,000 units and are popular among those in between. They balance profit with risk better than standard lots. A mini lot is shown as 0.1 on trading platforms, representing a tenth of a standard lot. They are good for traders who want to keep to a 1 to 2% risk of their account in each trade. Micro lots are for beginners or for low-risk trading experiments. They hold 1,000 units of the base currency. Each pip in a micro lot changes the value by 10 cents. This makes it safer for new traders learning without spending a lot of money. Micro lots help newcomers see the effects of lot size choices on their trades. They are useful for creating a low-risk trading strategy. Forex trading has lot sizes for all trader levels, from pro to beginner. By knowing about lot sizes, traders can make smarter choices. They can control the amount they trade better. With this, they manage risks more effectively. Lot size. Units of base currency. Pip value example, EUR/USD. Recommended use. Standard lot. 100,000. $10. Professional traders. Mini lot. 10,000. $1. Intermediate traders. Micro lot. 1,000. 10 cents. Beginner traders. Nano lot. 100. 1 cent. Experimentation. The base currency is key in Forex trading. It's the first currency in a pair. This shows how currency values move and helps in choosing the best ones. Usually, the US dollar is the main base currency. This gives a big advantage to traders. It's important to know about the base currency. This helps traders understand market changes. It also helps in deciding how much to invest. Understanding this can make Forex trading easier and more successful. In pairs like EUR/USD or GBP/USD, the US dollar is the foundation. It helps traders guess if the dollar will get stronger or weaker. This affects their trading moves.